right. Hello, hello. Nick, why don't we put the chat up on the screen while people are jumping in here? Hello, everyone. We're just going to wait a little bit to get on these different platforms here. Benedict, no, this meeting isn't closed already. Sorry, we were a little delayed in getting started. Needed to set up some stuff to show you guys. But yes, thanks in the comments. Happy Valentine's Day. And we'll just wait a few minutes, let everybody jump on, and let us go live on all the different platforms. It's still pulling up on all the different platforms. We're on streaming live, not just on YouTube, but on Facebook, as well as LinkedIn and a few other platforms. So thank you for tuning in, everyone. Hello, everybody checking in. Hello, Adam, Braden, Matthew, Benedict. Hello, everyone. Taryn. Hello to the Mortgage Calculator team. We definitely have a great episode here today talking about fix and flips. So we'll get into that more later, but definitely at the Mortgage Calculator team, we do a lot of fix and flips. That's for sure. And if you're out there and you don't, this is a great time to learn all about it. Hello, everyone in the chat, checking in. Happy Valentine's Day. In just a moment, we'll get started. All right. All right. Looks like we're live on all the platforms. Nick, you can go ahead and take the chat out here.
All right. You guys can still drop questions in the chat while we go.
Yeah, absolutely. Please drop questions. We'll go ahead and get started. Don't want to keep everyone too long on Valentine's Day. Maybe you're going out to dinner or something. So what we're going to do here today is go through the fix and flip loan. So my name is Kyle Hershey. I am the Chief Operating Officer here at the Mortgage Calculator, joined by Nick Hershey, our President and Founder, and Jose Gonzalez, our Sales Manager. And today's topic, as we do every Tuesday, doing a training for loan officers, is how to structure fix and flip loans. Now, here at the Mortgage Calculator, we do a lot of fix and flips, and it's not an easy thing to do. All right, that's why most lenders or brokers do not offer these products and programs, because you really have to know what you're doing to know the ins and outs. So today we're going to go through that. Jose, with 27 years of experience, has seen his share of fix and flip loans. He knows the amazing opportunity there is there, and also the trials and tribulations of going through a fix and flip loan. So I want Jose to talk a little bit about it. We also have a fix and flip quote that we actually did for a real property, and we'll pull that up. And then we'll pull up some of the info that you're going to need to do a fix and flip loan. So with that being said, Jose, why don't you talk about what a fix and flip loan is, and what kind of opportunity does that offer us as loan officers?
All right. That is such a great question. I don't know where to start. There's just so much opportunity right now. As I disclose all these loans for the team, I am amazed at how many fix, flip, and ground up construction type loans that we're getting, as well as commercial deals, DSCR, and everything else. But I mean, the mix of products that we're getting shows how deep we're getting out there to the investors. And the opportunities are there for those that decide to switch their mindset a little bit, get out of their comfort zone, and decide to find out what's going on with that fix, flip loan thing, right? And well, I'm going to tell you, if you can ask some of our seniors that are doing these a lot, if you can ask Christina, for example, I know she did 1-to-1 in person, one investor there. I think she did like 3 big loans, one shot fixed. The ultimate fixed flip, which is a ground up. You buy the piece of land, you build a house, and you sell it for a lot more money. So with the fixed flip type product, the main thing I would say that the MLO has to note is that it's not about the income of the borrower. It's about the income of the deal. It's sort of like same as the SER, it's the rental income of the property, not the income of the borrower. For the fixed flip, it's the same thing. It's about how much meat is on those bones, right? So if they're buying it for 100, they're putting in another 100, and they're gonna sell it for like 220. That's not a really big margin there. That may not pass the test for a fixed flip loan. However, they're getting it for like 40, putting in 60 or 70, and they're selling it for 250. Boom. You're probably going to get 100% financing of the repairs. You'll probably get maximum loan to value on the purchase. That would be the ultimate perfect deal. You'll probably get 85%. And if you look at the combined LTV, it could be as high as 90, 91% on the deal, right? So really sweet. So it all depends on how much meat is on the bones and how much experience the investor has. So I think, Nick, then you have a checklist there with some of the stuff that we need to take into consideration when we're even trying to size up the deal. You take off your like conventional loan hat and put on your fixed flip MLO hat. What is it that we have to do when we approach the investors to properly size up what we're going to offer?
All right, let me slide it over top of my graphic here. See if I can get it to work. Boom. So, I can zoom in still. Oh, that's too much. Right about there. That's good. So this is a form that we have for our team. If you guys go into our knowledge center, those of you on our team, you can grab this fix and flip questionnaire. I guess, can you read that from there, Jose, or you want me to?
Yes, sir.
I'll go through
Yeah,
line by
I
line.
got on the good glasses right now.
Do you want to go through line by line, or you want me to go through?
Yeah, I got it. So basically, on the first, this is more basic property stuff. If it's a refi, when did they purchase it? What is the name of the LLC that holds title? Or, again, if it's going to be a purchase, what is the name of the LLC that's going to hold title? Who are the number of members of the LLC? Now, mind you, in these fixed flip situations are really pretty flexible. These are viewed as more commercial type business purpose loans. So they will let just one person close. So if the LLC has one really strong borrower, that can be the person whose credit's going to be used, and you can use them. But they do want to know, how many members they have on there. Who's the primary borrower, FICO, which would be the person who we're talking about right now, the one that has whatever. What you put on there, 660?
I think that's our minimum for most of the good stuff.
Yeah, all right. Yeah, because my guy has 800. Yeah. He's walking on water, but so the primary borrower, how many, in this scenario, I think we were gearing it towards one particular conduit, so which allowed up to 1 times 12, but we want to know how many times in the last 12 months for the 30-day lates and stuff like that. Now here's where it gets really, now the first section is really basic, but here is really where it gets specific to a fix and flip, right? Number of flips for sale in the last 3 years. That's the first category, right? Then the second category, the next category, number of flips for rent, meaning that they kept it. One would be your flip to sell, and the other one is fix to flip, and then fix to flip into another loan, so you can hold on to it for a rental property. And then this is where it's really important if they're going to do ground up construction. Now, I think we have one program that will do it with no experience, one or two programs, but many of them require ground up construction experience. So they want to know how many in the last 3 years ground up constructions. And you can also substitute sometimes heavy fixed flip experience, like if they've done like really big projects, complicated type stuff where they added on like a half of a house or something like that. Definitely, they could probably take that into consideration and let that count, but you do have to be able to document it. um, who's the general contractor, or if it's going to be a self build? Really important. They will, and we do get that question a lot on the one-time close. You can't really do that on a one-time close, but they will let you be the builder or the GC in this type of a product if you already have the experience as a flipper. Okay, because I guess I should talk about this before I forget, because when we talk about experience here, we're not talking about home building experience, because a lot of times they'll tell me, oh yeah, he's a builder, he's built a lot of homes. That's okay, that's great, so he'll be a great builder, but he may not have been the principal or a principal on the flip from the inception of the flip, when it was the land that they bought, and then the land that was developed, and then carrying the note, and all that kind of stuff that you have to do while you're building the place, and then selling it. And throughout that whole process, you were a principal to that process. Then you can say that's your flip experience. But if your only experience in that process was that you were the builder, or you were a JV partner, but your name wasn't anywhere on the LLC, you just gave them money and they sort of had an agreement with you, you're out of gas. You didn't participate in the flip unless your name somehow or another is linked to the entity that managed and sold that flip. That's experience on the flip. So real important that we make that notation. So when you are structuring your deals, or when you are as a borrower out there, because we do have investors that listen into us, structuring your deal, know what we're talking about. You can get partners, for example. You can get a partner that has experience forming LLC with that partner, and then they can be the primary borrower with the experience on the flips, and then you can do the deal and benefit that way. That's the way a lot of people do it. So then exit strategy, sell or hold for rent. We do a lot of refinancing people out of the bridge loans into an end loan, because, the DSCR loans just fit so well into that. Then purchase price, which usually the purchase price ends up being the as is value as well, unless like you got it for 30,000 and it was worth 70 or whatever, you would only know that after the individual discloses that information. Rehab budget, you know, uh, total rehab budget, soft costs, hard costs, whatever they want to get reimbursed for. Let's put it that way. If they already put 35 grand into it in soft costs, and
Can you
they don't
explain
need to get.
soft and hard costs, Jose?
Yeah. Okay. Soft costs would be like planning and development of the project. Could be anything that you spend other than laying down brick and mortar, right? So architectural plans, paint, all of that, running it through the permits, all of that upfront legwork. You may even have to do soil compaction tests and environmental tests and this and that, depending what you're actually going to do with that land. Those are all soft costs, and sometimes they can get pretty extensive if you get to a phase 2 or phase 3 environmental on a commercial project. It can get pretty. That's like you find contaminated land, and so they go a phase 2 to see how contaminated it is. Okay, and now we got to see what we got to do to remediate and how deep it got to go. So it could get crazy. So
Can you talk about time there too? A lot of people are confused on
yes,
the time there.
yeah, because time is of the essence on these things, right? You're paying for, usually the interest is if there's meat on the bones there, the interest is going to be prepaid, included in the deal. So they want to make sure that you are locked and loaded, right? That the plans are there. If it's a build, especially if it's a fix and flip, it depends how extensive it is. But you got to have your contractor in place. You have to have estimates in place, and depending how extensive the the build that you're going to do on that fix and flip, they may require plans, that may require permits to be pulled before they may allow it to happen. So you sometimes these deals, they are subject to a certain amount of scrutiny.
And the soft costs are commonly the costs that they have to incur actually before we can actually take the application. So I just want you guys to understand that if there's a phase 3 environmental, you're talking like 6 months before we can even do a loan on the place, right?
Yeah.
Like it's going to take a long time to go all 3 phases. How long does it take on those deals you've done? You've done as a realtor for the most part, right?
Well, man, I mean, I just imagine you're getting caught in a bureaucratic situation with municipal governments and things like that, county government, sometimes state government, sometimes DERM. This is more on the commercial side, not so much on the 1 to 4 unit, but it can be an issue on a commercial deal, multifamily. Something other than the 5 to 8 units that we can do that are really cool. But yeah, time is of the essence. So you want to make sure that all of these factors have been taken into consideration, that at least the contractor is in place that can provide that estimate really quickly, and then again, typically, the flips are not so complicated. It's kitchens, bathrooms, floorings, paint, windows, blah, 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 blah. No plans are needed. They know it's just permits are going to be quick now. Pandemic is, relaxed on that, or, we're going to go quick. But if it's a ground up, that's going to be a different story. Yeah. Mm-hmm. But now, again, we have the rehab budget there. And then because this is all information that you're going to have to transfer to get the different options. And then you have the famous ARV, which stands for after repaired value. So it's real critical when we're handling these deals that when we're doing things like ordering the appraisals, making sure that if we as the lender, loan officer, or whatever our function broker may be in that transaction, that we order the correct appraisal, and that usually that appraisal on this type of deals is going to have an ARV component to it. And you'll have to upload the scope of the work for the appraisal, which is going to include these estimates that we're talking about. If it's more extensive, they may even ask you for the plans and other things associated, because then the appraiser is going to have to calculate, okay, this is what the property's worth now, this is what you're doing to it, and this is what it's going to be worth when you're done. They're going to actually have to look for comparables that are going to fit whatever you're building. If you're adding on space, it's going to be that size. If you're adding on condition or whatever you're doing, they'll try to find comps, and that's how it's going to be. So, make sure that the correct appraisal is ordered. And then, we size up the deal. We have multiple options programs available for all levels of investors, right? From our novice, haven't done ground up yet, but I have $500,000 burning a hole in my pocket and 800 credit. Yeah, that person's going to be able to do something, right? We have no experience ground up. If you got credit and equity, that's what it's all about, and a project with meat on the bones. That's the most important thing. You bring that great deal, they're salivating too. They're making 12, 11, 12, 13% interest rate. So, they want a good deal here. But, it's all up to how the deal is sized up. And that's what I wanted to show here.
Last couple things here, Jose. I want to make a couple pointers.
The estimated rents. Okay, the estimated rents is going to determine the exit strategy.
Exactly. That's what I wanted to ask you.
What they're going to do here. So if you're telling them this is going to be a flip and hold, I'm going to keep it as a rental. All right, they're going to they need to make sure that you have taken into consideration at least. So, you're going to provide what the estimated rents are. And of course, that'll be confirmed with the appraisal that's going to be done. It will probably have some type of, if it's going to be to hold it, then they'll have an additional component to the appraisal to check the market rents and make sure that it is going to be that. And then
I wanted to prompt you for one more thing though, Jose. Just make sure when you're sending these quotes, we're always going to ask this because we're always going to give our investors a takeout option, right? The investors always need a takeout option because sometimes flips don't sell. And you know what? The investors right now are taking a crapshoot on a flip right now with all the, the market turmoil and all the media talk, right? So they know that they might not sell and might not get their numbers. So they all need an exit strategy. So please don't forget to ask this question so that you can always provide your investor with the flip and the takeout, the long-term DSCR after. And you won't be able to without talking about estimated rents and giving them a target, right? So let's give them a target to hit for repairs and a target to hit for rents so that we have the takeout option as well at the end. So I wanted to prompt you for that one, Jose.
Super important. Correct. I mean, we would not be doing our job properly as a consultant if we weren't taking the whole picture into consideration. And I mean, you don't want to buy something that you can't get out of either because it's underwater in the rent. I mean, and your LTV is too high to do a no ratio or whatever it is that you need to do to resolve it, and whatever whatever it is. We just want to consider all factors, and so does the investor who's lending you the money.
So, and then let me prompt you for another one here, Jose. There, what'd you say?
Oh, I said, and then it becomes two loans for us as a loan officer. We do the fix and hold, fix and flip technically, and then we hold it, right? We do a DSCR out of it. So,
and let me be clear, even the investors that are planning on flipping it need an exit strategy, right? That might not go the way they expected it, so always give them an exit. So every fix and flip comes with a DSCR quote, guys, from our team, just so we have an option for them and put it on the table so they know what they're looking at once they finish their masterpiece, right? Jose, let me set you up right here. Is there such a thing as TBD, pre-approve me for a fix and flip?
Yes, to an extent, but not anything you could really give a pre-approval letter and say, okay, go to any fix and flip property and you're good to go, because there's couple different factors need to get taken into consideration. One is the borrower. So we mentioned, yes, okay, the borrower is going to have a certain credit history, no late pays on mortgages, preferably a certain credit score. Borrowers need to have a certain experience level depending on the loan amount and certain borrower related factors. But that's it. But if the deal, the TBD, now becomes 123 Main Street, and 123 Main Street only has an 8% profit margin on the deal, that's going to be a big, nobody's going to take that deal. And you're going to say, oh, but you pre-approved me. I say, yeah, for a deal that has profit margin. And we don't know until we get the deal and then we run it through the proper analysis models that they have. And the model is going to kick out sort of like a DU for fix and flip. You kick in the deal and it kicks out a result, and it's going to be certain percentage, certain LTV or not.
Exactly. So we're going to be missing purchase price, as is value, rehab budget, ARV, estimated rents. All of the values that go into creating a quote, we're going to be missing on a TBD flip because there's no such thing as just making this up, right? Every property is different. Even if you go to like a track home build, right? The one on the left burned down. The one on the right just had somebody, had a mold problem or a water leak. Two totally different things, and the purchase price is going to be different on both, right? So totally different things. Same exact house, same exact square foot, same exact land, everything totally different fix and flip. So that's one of the most common questions, and it's just, I would just say to our team, there is no such thing, right? It's just too hypothetical to even go down that rabbit hole of, yes, it could work if this, if that, if this, if that, if this, if that, rather than just say, hey, find a property and let's quote it, right? Let me prompt you with another one here, Jose. This is super common. Can you just explain why we have different terms here and why we need to be cognizant of this for obviously like the exit and whatnot. Just this doesn't seem as important, but this is super important if you guys pay attention in structuring your deals. So
Well, I mean, obviously, again, this is going to depend on the loan amount and on how extensive the deal is. When the underwriters are reviewing your deal to accept it, that's some of the things they're going to be looking at is, are you on top of your game, or do you look like you're going to be dragging your feet? But at the same time, you don't want to cut yourself too short and maybe not ask for enough time if they're going to be offering it. I mean, either way, most of the deal, if the deal has equity, you would be able to include that interest into the loan, and it would be taken into consideration in the whole equity investment required by the borrower. And notice I call that equity investment, right? Because if the deal has more equity, that's good. It usually means a little less investment from you. If the deal has less equity, that means more investment from the borrower on that deal. And some deals at the end, they're just not going to do them if they feel they don't have enough equity. It's not because you're going to say, "Oh no, man, come on, 14% is good enough for me. I'm not greedy. Come on, why won't you do it?" Well, that's because that's such a tight margin that if anything should happen in that transaction, like look what's happening right now with the cost of materials, right? Cost of materials spiked up, the cost of wood, the cost of concrete, the cost of steel and metals and all that. If you're building something, that's going to eat into your profit margin, and then any little market fluctuations with the rates and the this and the that, and all of a sudden the flip's not working so well in the sale, right? Now that's why if you were working with the mortgage calculator MLO on this loan, for example, we would already discuss with you the estimated rent. We would already have had that plan B already there, locked and loaded, the pre-approved DSCR or whatever investment property loan was applicable. Because we do have, again, zero seasoning loans that will allow you to transition. And this is where adding value, this is where when you're speaking to the investors out there, and this time I'm talking about the people who are financing the properties, not those we're selling the loans to. When you're speaking with them and you're talking about all of these, exit strategies and the end loan being the DSCR going right in, you're talking to them, these nice low rates on the DSCR. They're saying, why was I selling these properties before? I could have been holding them maybe for a year, making some good rent, and all of a sudden I'm making 3 times the money when I'm selling that property. But they were selling them because they didn't think they had a choice. Remember, they didn't know DSCR existed previously, usually through talking to us. So, I mean, that's why we're going to be proactive. And that's why, we love doing these loans. And that's why I know we're getting so many of these loans in our pipeline as I disclose them on a almost daily basis with all of our team. And so, yeah, 12 or 24-month team is just going to change the rate a little bit. Let them tell you no. I'm not going to give you 24 months, or no, I'm not going to give you 18 months, because you can pay it off, sooner. Nobody says you got to keep it until the end, but, you want to have options. You don't want to be like these people that are 2 months over the flip. Now all of a sudden they got to refi the flip. They're not done yet. The place doesn't want to refinance them because they could tell that they're out of control. So now they're running around with a half-done flip, trying to get $100,000 more dollars or whatever, because they ran out of time. Mainly, so
yeah, the time stamp is hard too, and a lot of times that's where they make all their money too on these loans, guys. Is because they're going to charge 2 points just to extend it. They're already charging 10+ % interest on these. Then they're just going to charge you 2 points just to extend it. So don't let your borrowers get in trouble. Make sure you manage their expectations with this. That's why I want to make sure Jose talks about it, because you could just get the default 12 months. But if your person doesn't know what they're doing, or if this is an extensive project, I mean, there's many projects that take 12 months, even without being super extensive. Things happen. So be very careful there.
Absolutely. It makes it very difficult to refinance it if they're already beyond the time frame. That already makes them look bad.
Yeah, and
So
then you're trying to get the VOM, and the flipper and the private money source that's holding the note is not going to give you a clean VOM because they're like, no, they went past their due date and they're not going to give you anything
exactly.
positive to say, and then it's going to get an impasse. So you
Yeah,
want to
don't put your borrower in that predicament. I mean, I actually spoke to a prospect today that was doing 6-month flip loans, and at 6 months they had to be out of there.
oof,
And how we got them, how I basically, what delighted her was the zero seasoning, because she had not heard from anybody of that exit strategy. And when I was speaking with her, this was at our event, and she was complaining about, man, can't believe had to put this property for sale. I really wanted to keep it. It's such a great property, but man, all these people I was talking to, everybody told me they couldn't help me out, because, and I'm like, why? Oh, because they said that it had only been 5 months and I had to wait at least a year to do it, or at least minimum 6 months to try to do anything. But my flip loan is done at 6 months, so I have to get out before 6 months, or else she's going to have the dilemma that we just discussed. So she sold the property, but now she just got another one, and we're going to put her into a DSCR, be her exit strategy. So I wanted to share the.
hold on. I got one question, Jose. We got one question that we need to go. Or actually, let's see. Let's do two. Let's do two questions. Looks like David with both questions. First question here: two contractor estimates or one estimate? We can do one estimate, correct, Jose?
Yeah, I mean, yeah, I don't think that there's any issues with the fixed flip loans. If they approve the contractor, because remember, they don't care how many estimates you bring. What if those other estimates are shoddy contractors? Once they approve the contractor's credentials, then they will review the estimate according to the scope of the work. They know what's up. I mean, they know what it should cost in an area. They have estimating models and computer programs and all that kind of stuff. They'll run it through, and if it makes sense, it'll be accepted. And that's basically what it boils down to. It's more about is the contractor approved by them? Good credit, good work history, good track record. Does he have a line of credit? All these things that contractors may need to be able to be a good contractor.
Thank you, sir. And then another great question here. This one's pretty drawn out, but David with another great question. You see it there? A lot of times the investors don't have enough cash to finish, or MLOs don't explain how the draw works. Please explain draws. When I explain them, I'm usually told no one explained how it really works. So how do the draws work? That's a great question. It's hard to explain that with this questionnaire. So that's kind of the next step, right? When we're quoting the customer, once we have our actual quote, we need to explain that. So you're exactly right, David. So Jose, you want to talk a little bit more about how to frame that up?
Yeah, I mean, David, this is like asking me a general question on a DSCR loan. Can you do this on a whatever it is on a DSCR loan? I would have to refer you to the guidelines. In this case, the guidelines of the program that we've selected, because we have multiple fix and flip programs, all of them depending on a number of things: experience level of the flipper, credit, the deals. Some will take sketchier deals than others. So many different things to look at, and they all have different draw programs. They all have different draw methods depending on the experience level of the flipper, and how good of a deal it looks like. Some will even allow a good amount of upfront draw also. Again, that's all of that in the end is going to depend on the deal, and
Yeah,
how strong they see it.
we had one outlet with advanced draws, but that's again very restrictive. I think they had to have 10 flip experience in the last 3 years to get the advanced draws. But David, you're exactly right, though. I think the pitfall that you want to highlight here for the team is that if you don't explain that the contractor, or if they're self-billed, them must have, as Jose mentioned, you guys might not have caught it, line of credit, right? If the contractor has no line of credit, right? If they can't go to Home Depot and order $30,000 worth of windows and get the windows to the place, guess what? They're going to have $30,000 cash in their bank in order to make that order, because we're not going to give them $30,000 for those windows until those windows are installed and the permit is approved, right? They're installed properly, right? Then they can submit for their draw request. So a draw isn't an advanced draw, which most people might think, and the word draw kind of means advance, right? Some people think like a payroll draw, right? I want my money ahead of time. It's actually the opposite, right? Our contractor has to put up the whole $30,000 for the window order, install the windows, pay all his subcontractors, right? Because he can't have, sub liens on the house, right? He has to pay all his subcontractors. That's why this contractor is important. Because also you could have a contractor blow your whole deal, right? Jose, you could have a contractor have a sub, and the sub does a mechanic lien on your house, right? A lien on the property because the sub wasn't paid by the contractor on time, because the contractor was trying to pay the $30,000 for the windows because the contractor didn't have a line of credit because we didn't explain the draw process. So it's not the borrower's fault, David. You're exactly right, but that does happen. And we don't want to get our borrowers in that situation where someone doesn't have the money to pay for the $30,000 in windows, right? The $30,000 windows got to get on the house for us to get that $30,000 window draw. So it's a reimbursement. Exactly, Mo, in the chat. It's a reimbursement. Draw is a very misleading word. So make sure you let them know. I think the better thing is reimbursement. I like that word, Mo. Make them understand that it should be reimbursement. If they have 10 flips, then it's more an advanced draw, and then it's more like of what you might think. So anything else to add on that, Jose? I think that's what he kind of wanted to highlight.
No, I just think that that's one of the critical components here, and why some of these transactions, these flips fail, is because they're undercapitalized. They may be lacking some liquidity. They maybe the money's going to be there, but they had a different idea of at what point it was going to be available, and now they can't even get the project started. And how are you going to lay down steel and concrete in the ground and do foundations and do all these things, and you don't got like $100,000 to start? So some do give you a little bit. It depends. So again, reach out to the AEs. When in doubt, we do have all. Some do allow some advanced draws, but you're gonna have to have a lot of experience. It has to be a great deal. It's case by case. You cannot be stating that that's possible on every single deal. That's all of this. A lot of times is going to be case by case. Always.
Exactly. All right, I think we're good on the questions. You want to go with your example? You want me to pull that up?
Yes, sir. I have. This is an actual deal that we ended up quoting, right? And this was a fixed flip, 85% LTV purchase, 100% rehab, where if you look at the deal, this is experienced investor, 5 flips in the last 3 years, no prepayment penalty, and 12-month term is what they were doing here. Purchase price on the as-is home, $400,000. Rehab budget of $100,000. Not very extensive. This person's probably putting in some sweat equity there, I'm sure. And after repaired value, the ARV, $700,000. So there's definitely he bought the little house there and sprucing it up, right? Flipper's dream. Look at the profit on that. Total loan amount. Here's where it gets good, right? Notice we have a purchase price of $400,000, right? But due to the equity in this deal, they're actually going to lend them $440,000, but it's broken down that they're going to have to give a certain percentage of it up front. So their down payment is $77,990, right? That's what they have to give at closing in down payment, plus a liquidity buffer of 1.5%. Hold on, let me move this back down a little bit. Plus a liquidity buffer of 1.5% of the loan amount. That's like a little extra in reserves. that they have to figure, and then debt service of 12 months interest, $36,112. So you have $120,702 is what this person borrower has to come up with in total, has to show. Now, if we look at the deal, total cost here, 502,440. That's not taken into consideration. Oh yeah, right. So we'd have to take into consideration the closing costs there, obviously, but they're not taking into the gross profit there. But that's where we're looking at 87.57% loan to cost is what they were able to borrow.
I think that program has a max of 90. So you tried to max it out, but obviously.
Yeah, right.
So this is a great example of Jose even tried to max it at the 90 to get the max leverage, right? Just for you guys to show an example. And it's just so hard to pencil these fix and flips that he was only able to get 87.57 because so many different factors play into these
This was actually very close numbers to an actual flip that somebody did on our team with somebody. Yeah, this was like a really good deal. I think it's pretty much what he was getting. 28.22% ROI. Again, we got to look at the closing costs in there and stuff like that. So look at the numbers here, right? So I think it worked out pretty good. We're figuring $37.55 per month as the interest only payment, and then that was it was collected up front. So for the upfront money that they paid, they got the whole project, everything, in and out, all the rehab, loan payments, everything done. So obviously this deal had some meat on the bones, but this is what you can do if you size up the questionnaire, go to all the different outlets, all the different options that we have, run it through the different program parameters, and you're going to get similar results. And in a lot of cases, you'll be surprised at how many times you'll be able to have be able to provide 100% financing to a borrower for the cost of the rehab. And in these cases where they use the after repaired value, where they're going, let's say 70%.
Hey, can you scroll back down to the leverages real quick?
If you're going 70% in some cases.
So we can go 70% ARV, I believe, and 90% loan to cost are our max leverages that we can get on these programs.
Yeah. And then, which, if it's a good deal, they're almost always on these good deals, you're going to be able to get them 100% financing of the rehab. So most of the time that'll happen, unless it's something that doesn't have any meat on the bones, So here, it's 62% of the ARV, but that's because this one had such a high ARV also. Don't think that means, I didn't get enough. No, I mean, we got more than the purchase price, with that. So take that into consideration there.
And usually the ARV is going to limit you, not be a good thing, right? So you want to hit the loan to cost. The 90% loan to cost is really the max leverage, right? The loan to cost, LTC, that middle one there, is really our leverage point. So if you want to max that out, you really got to pencil out some deals. And, some of our programs don't go to that high. They might go to 85. But if you can pencil out the right deal, you can get that 90. It's pretty crazy.
Absolutely.
All right. Well, let's go ahead and wrap it up because I want to make sure that we get done on time today. So, as they talked about, fix and flip, definitely a great program. Also fix and hold, which a lot of this applies to as well, right? So definitely check it out and use it. As far as the people on our team, that fix and flip questionnaires in the Knowledge Center, and that's what you're going to use as you embark on that journey of making sure that you fill out that info. That's the info you're going to need just to get started. Right. And then after that, you'll dive into it more. So With that being said, thank you, Nick. Thank you, Jose. That was great. We will see everybody tomorrow on Wednesday for the sales training at 7 p.m. Eastern right here on our YouTube channel. And then, of course, see you next week, next Tuesday, for the next mentor meeting, loan officer training. Everybody have a great night. Happy Valentine's Day.
All
Thanks,
right.
everybody.